Hey, good morning. This is Jake Adams, and welcome to the tax savings team. Today, we're going to be talking about a monetization loan coupled with an installment. Now, this is referred to as a couple different things. There's a trademark term, M453. Sometimes it's called an MIS. Sometimes it's called a monetized installment sale. So it can be referred to as many different things, but we're going to be talking about it through its tax definition. This is actually what was reported on a official chief counsel memorandum from the IRS. And in their words, they officially use the words a monetization loan coupled with an installment agreement. And the installment agreement is part of the Internal Revenue Code, the 453, right? Internal Code 453 talks about installment sale. So essentially, we're doing an installment agreement sale. But what's happening with this, and why this is so powerful and why this is so helpful for clients, is because it allows them to defer the taxes for 30 years when they're selling highly appreciated assets. So a house or business or commercial property, commercial businesses or commercial building, things like that. So essentially what's happening here is we're coupling a loan with an installment sale, and because the installment sale will let us actually push out the tax, the official tax point of sale, or the way that the way the 453 defers the taxes is through the recognition of the gain. So it essentially pushes that out for 30 years. All right, we've got a couple people on here. I just want to say hi. We've got Terry, we've got Moja. Hey, welcome. Kathy, Vern, good morning. Good morning. Thanks for joining me here. We're talking about the monetization loan coupled with an installment agreement. And this is an advanced tax topic for CPAs, for enrolled agents, for tax pros to share with their clients. So I want to share it with you. And this is part of the community. You're going to get access to these kind of advanced tax strategies, these kind of topics, and then the people and the partners that can help you implement them. So that's part of the tax savings team where there's a lot of value there, because we have the partners that can help you implement this with your clients. All right, so let's talk more about this. So essentially what happens is, let's say we have an asset. Let's say it's a business or a house or a commercial building, and let's say this asset is here, right? All right, let's just say this is a house. And here in the Bay Area, the San Francisco Bay Area where I live, the housing prices have just gone crazy. Like my house, for instance, I bought it, I think 7 or 8 years ago, and it's gone up at least $500,000 in value. It's just nuts. So what happens is people that have bought, let's say people bought 20, 30 years ago, and they bought it for $60,000, $70,000, maybe $100,000, and now it's worth $1 million, $2 million, or something crazy, right? And you're like, well, who's seriously out there paying this kind of money for these houses or these businesses? But it's true. I mean, people pay it almost every day when there's houses available for sale here in the Bay Area. So let's say it's a house, and let's say we're going to sell a house for, like, I don't know, $2 million. So essentially what would traditionally happen with a sale is you have a house and you have a buyer, and the homeowner would sell the home, or the business owner would sell the business to the buyer, and you just have a straight transaction. But what happens is that triggers the capital gain. And what we want to do is try to defer that capital gain for 30 years. So what happens is there's a dealer here in the middle. There's a kind of intermediary, same thing like a 1031 intermediary, and then you have a lender. So there's two third parties, if you will, that are going to kind of get in the middle of this transaction. So essentially what's going to happen, and this is I'm going to oversimplify it just so that you just kind of the five-minute overview of it, so you can explain it if someone comes along that you think could benefit from this. And then, of course, we can go into the really detailed, the nuts and bolts, spend an hour or two on it, because people have a lot of questions about this. But I'm just going to go over the overview, the 5-minute overview here. So essentially, the homeowner is going to transfer it to the dealer, and then the dealer is going to sell it to the buyer. So the dealer sells the house, in this case, to the buyer, and the buyer is going to pay the dealer money. And then what happens then, the dealer holds on to that money. And that's the important thing about the MIS, the monetization loan, is the dealer is actually holding the money. And then the dealer gives the seller a 30-year note. And that's where the 453 comes in, the installment sale. That's the 453. So what's happening technically is that the homeowner, the seller, isn't going to get any sales proceeds for 30 years. They're only going to get interest payments. Then what happens, because most people are like, well, I could do that on myself. I can do that myself. I don't need a third party to do that. What happens in this particular situation is the lender steps in, and the lender gives the seller a loan for 93.5% of the proceeds. So this lender steps in and gives the seller a loan for 93.5% of the proceeds. Now this 93.5% is very important, because when the IRS is looking at this, they're going to say this is not a step transaction. This is not there's no substance over form issues, because not an equal amount. It's almost equal to, but it's not exactly the same. So this loan is a business loan of about 93.5%. So where does the other money go? Well, the other money stays with the lender and the dealer. They actually have a 30-year escrow that happens. And this 30-year escrow, that's between the dealer and the lender. They push that out. They take care of all the escrow and all the stuff that happens with that. And essentially this loan never has to get repaid. And the loan never has to be the dealer. And then now over that 30 years, this money is going to get transferred to the lender. Does that make sense? So that means that the seller never has to pay back their loan, because the dealer is sitting with the original money. The dealer is going to pay off that loan to that lender in 30 years. Now, they've been doing billions and billions of transactions like this, so this is nothing new for them. They know exactly what they're doing. They know what their investments are over that 30-year period. And the most important thing with this loan is that it's unsecured. So let me write that over here. Unsecured. Now, why is this important? It's really important that this is an unsecured loan, because the homeowner or the seller of the business or the home, whatever we're going to sell that we're going to try to defer the taxes on, they don't want to be wrapped up in anything that the dealer or the lender is doing over this next 30 years. Right? They want this unsecured because they don't want to have any recourse. They don't want to have any recourse to what's going on with these guys or what's happening in the next 30 years. They want their money 93.5%, almost equivalent to what they would sell it for. They want this money, and they just want to kind of wash their hands of it, be clean. So that's really important that this is an unsecured loan. Now, you might be asking yourself, what happens to this money? Well, some of that money is actually going to go to you as almost like a finder's fee or a commission for bringing this to the dealer that's going to set this up. And your commission on this, or your finder's fee on this, as a CPA, enrolled agent, tax pro, tax planner, tax professional, really your fee on this now, if you're talking about $1 million home or $1 million business, and you're looking at 1.5%, what does that look like to you? It's about $15,000. So actually, I did one of these just a couple weeks back for a homeowner that had a renter in an older home with their family, and he loved this idea. He says, "Yeah, I'm going to be around in 30 years. I'm going to take care of this. I'm going to invest the money. Things are going to be great." So he was more than happy with that, and I was more than happy with a $15,000 commission from doing this, right? So please, if you have any questions, feel free to type them in the comments. If you're watching this live, if you're watching a replay, still type in your comments. Let me know if you have any questions about this. And then I'm going to go through some of the frequently asked questions, because people usually have a lot of questions on this. Like I said, I just want to give you a 5-minute overview on how this works and how this looks, and why this is beneficial for you, and then also why it's beneficial for your client. So whenever I'm talking about this, I also like to talk about this 30-year deferment, right? Because like we said, in 30 years, the tax is going to come due. So we're going to want to have a game plan. In 30 years, what's going to happen? How are we going to pay that tax? And when I'm talking with clients about this, and when you're talking with clients about this, I want you to emphasize the time value of money, right? So if you're not familiar with the time value of money, go back to your college textbooks, your college finance textbooks, and dust them off. The present value, the future value, present value calculations. You know, you remember back from college, we used the TI-83 calculators and plugged in the present value and the interest calculations. You know what I'm talking about. So 30 years, what we're going to do is we're going to figure out what is the present value, what is the future value of this money, right? So let's say that we're going to defer a tax of, let's say, $300,000, and we have $100,000 that we're saving here, right? Or by deferring. So we're deferring $300,000 of taxes. So let's say we have an extra $100,000, kind of just save for that $300,000 tax bill in 30 years. So what's going to happen if we're looking at, this is money and this is time. So this is 1 year to 30 years. What's just $100,000 today? And we can get an 8% interest rate. I'm not a financial advisor, so I'm not saying, oh, this is where you get 8%. This is how you like trick the market or anything like that. No, if you look at the stock market historically over the past 30 years, it's about an 8% return. But like I said, I'm not a financial advisor. I'm not giving you any financial advice on where to put this money or how to invest. But if you did invest it and you earned 8% for 30 years, your $100,000 would turn into, right? You like my hockey stick, right? This is the compounding, the compounding interest. Your money would turn into $750,000 approximately. And you can do the numbers on Excel if you want to. But essentially, if you invest $100,000 at 8% for 30 years, you'll have $750,000. So what does that mean? Well, that means that if we had, let's say, a $300,000 tax bill, and you've got $750,000 now to pay that off, now you have a net of $450,000. Yeah, you got to pay taxes on it. Yeah, you can't touch the money or do anything with it for 30 years. But that 30-year period allowed you to create, or more, or less, depending on what the market does, depending on what your investment does. So that's important. But 30 years, it's a long enough time frame, a long enough timeline that people are can kind of do the market rides, and if they invest in real estate, the real estate rides, things like that. So that's really important. So what's going to happen is you have an extra chunk of cash there in 30 years that you can pay off the tax bill. Now you're going to ask me, okay, I mean, I didn't really give you specific numbers here, but let's say we did defer $300,000 in taxes. We only use $100,000 to invest. You have an extra $200. So what can they do with that money? They can literally do whatever they want with it because it's cash, right? You're not stuck in a 453 note. If you do your own 453 note, your own installment sale, you have to wait for those payments to come in, right? And things like that. So with the monetization loan coupled with the installment sale, you don't have to worry about that. You have your cash, and your cash is clean, and you can invest a little bit of it and keep the rest, do whatever else you want with the rest. You can invest it and blow it in Vegas on a really fun weekend. If you spend $200,000 in Vegas on a weekend, please let me know. That sounds like a really I'd like to go. I'd like to join you with. All right, so checking if there's any questions. I don't see any. Guys, if you have any questions on this, feel free to type them in. I would be more than happy to answer them for you on here. Like I said, I usually get a lot of questions. The biggest questions usually is the 30 years, right? And then the other question I get a lot is, what happens if I'm not around in 30 years, right? What happens to the money? What happens to the tax bill? Well, it actually goes to the heirs, or whoever inherits the estate. So if you have kids, if you have heirs, the tax bill will transfer onto those heirs. That's why this is really important, letting them know, hey, I put some money aside and it's growing in this account. So make sure that you don't like blow this when I pass away. You know, you got to hold on to that money to pay that tax bill in 30 years, which is going to be yours. If you don't have any heirs, if you don't have any kids, and you want to just donate the whole thing to charity, or you don't do anything and it just goes to the state, well, charities and states don't pay any taxes. So if you pass away and you don't have any heirs and everything's going to go to charity, you don't have to worry about this at all, because the charity is not going to have a taxable event from the inheritance of this property. All right. So again, this is just a quick brief introduction. I'm going to post in here a little bit more technical, detailed analysis, a little bit more about what happens between the dealer and the lender in that 30-year period. I'm going to post that here in the comments. So if you're interested in this and you want to know more technical details, check out that video. If you have one of these that you think might benefit you or your clients, please let me know. Contact me. I will set you up directly with the dealers or directly with intermediaries that connect you with the dealer, and they can spend some time with you explaining the whole monetization loan coupled with an installment sale in its full detailed dexterity, and allow you to talk with your clients about it, allow you to have that partner to work with you and your clients on setting that up. Now, why is this really important? Well, the commissions are great, but what's really important about this is it's an advanced tax strategy that you can say that you now have a back pocket when you have clients in this particular situation and in this particular scenario. So is this going to work for everybody? No. It's highly appreciated assets or highly appreciated businesses, and it only works in some cases. But the goal of the tax savings team is to give you these advanced tax strategies that you can share with your clients. They're arrows in your quiver, if you will, that you can share with your clients when the time is right, and allow you to position yourself and allow you to feel comfortable and confident with being an advanced tax planner, an advanced tax strategist. So thank you so much for joining me today. My name is Jake Adams with the Tax Savings Team, and have a great rest of your day.